there are so many people that have got into real estate projects and just got their face ripped off because the debt structure came due. A lot of assumptions didn't pan out. And all of a sudden, they're not only jeopardizing the project from a return standpoint, but the original principle, which is a cardinal sin.
So I get as somebody that is in the single family home investment space and looking to diversify and get another bigger deals like what you would do in a syndication. I love the idea. Like for me, I think of my single family homes as like forever cash flowing machines. This idea of being in a syndication at a lower entry point that I can continue to like compound and diversify the deals that I'm in and continue to build that cash flow over time makes a lot of sense to me. If I was going into like a fractional thing and it had such a long-term time horizon, I guess there's got to be on-ramps and off ramps of that like forever cash flow thing. How do you sort that out?
They're obviously within the operating agreement. There's going to be different terms for scenarios that happen in life. There'll be refinance events because the debt structure is something you're going to redo because the loan terms are going to be, that's not going to change. But we're not going to be in a vulnerable place where there's a lot of people, again, they were borrowing at these low rates and then the rates jumped up and now they're underwater and now they got a fire sale or they do something. So our standpoint is never putting the property in a position where the debt structure is going to upend it. Because when you get into that situation, you get desperate and then you have to start going to, mezz debt and they're going to charge you 20% plus. And then you just start a slow death. And so there'll be refinance events essentially.